Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome, everyone. I'm a stock strategist here at Zacks Investment Research, and I will be covering today's first top stock of the week. So let's jump right into things. And my top stock pick of the week is Zacks' number 2 ranked buy stock, StoneCo, and the ticker symbol is STNE. And Stone is the Brazilian leader in financial technology solutions. Investors can think of the company as the Brazilian equivalent of Square. So Square has the point of sale kiosks. It's also known as Block now. But Stone is really the Brazilian version of America's Square. And as I mentioned, Stone offers payment solutions that empower merchants and integrated partners to conduct electronic commerce seamlessly across in-store, online, and mobile channels. The company serves clients of all sizes and types that transact online, offline, or have an omni-channel sales approach. So one of the main reasons that I'm picking this stock for my top stock of the week is that I think it's important that investors look for opportunities wherever they arise. I know there's a lot of stocks that are acting well in the United States or domestically right now, but in my opinion, it's also worth focusing on emerging markets as well. So investors may find benefits to tracking emerging markets because they're earlier in that growth trajectory. Obviously, the United States is developed. Brazil is a little bit lower down on that curve, which can present opportunities for investors. And in the US, for example, the payments market is already mature and there's less room for growth. Secondly, emerging markets provide us with that diversification. So if your entire portfolio is too concentrated, if you get a pullback in US markets, for example, you're going to get hit pretty hard. But if you have some international stocks mixed in there, an adverse price move is not going to devastate your portfolio. So it gives us some nice diversification, some nice growth. Now, getting into the stock itself, as I mentioned, unlike the US market, Brazil's digital payment market is less saturated because a lot of Brazilians are still using cash as a means of payment rather than digital payments. But that is moving quickly in the other direction as Brazil's economy develops more and more and citizens begin using those digital payments. So after a brief pandemic-induced period of negative earnings per share, Stone's consensus analyst estimates are anticipating big growth over the next year. You can see I highlighted, for example, next quarter, consensus analyst estimates are expecting a spike of 250% or 240%. So really, really strong expected growth to go with the themes that I have discussed earlier. Now let's get into the recent revision history, because when determining the future direction of a stock's price, you need to look at what the company will earn in the future and also why earnings expectations or earnings are so important is that those recent changes tend to reflect on the stock. So Stone's recent revision history paints a rosy picture. Analysts have become more bullish in the past month and believe the company will turn the profit spigot on once again in the coming quarters. And all of the analysts seem to agree on this. If you look at this chart, they've all moved it up over the last 60 days. I think there's 4 or 5 analysts covering StoneCo from our Zacks consensus estimates. So really, really strong analyst estimates that we like to see here. Now, moving on to the valuation. So Stone shares have been consolidating for more than a year while the company has been growing top and bottom line. So the share price hasn't reacted just yet, but the company has more than 325 million in free cash flow, so really nice free cash flow. It trades at 12 times 2024 earnings and 11 times 2025 earnings. So Also, we're expecting EPS growth of more than 50% per year. So from both a valuation and growth perspective, it's kind of a growth at a reasonable price play, in my opinion. The price to book is at all-time lows for the stock. And in my opinion, the stock is valued artificially low due to the temporary coronavirus pandemic effects. So for this reason, the stock has attracted the who's who of institutional investors. Warren Buffett has a position, Steve Cohen has a position, and Ken Griffin. So some really nice company to be in as far as the institutional investment side is concerned. Now, beyond the fundamentals, the technicals are starting to act a lot better, and there's a lot of room on the technical side. So what I have pictured above is a longer-term chart of STNE. The stock is attractive at these levels for multiple reasons. First, the stock broke above the 200-day moving average, which is the red line that you're seeing on the chart. Secondly, the stock is breaking out of a base that is more than a year long after several failed breakout attempts. So early longs have kind of been frustrated, which I look at as a positive. And there's an old Wall Street saying that says the longer the base, the higher in space. So this is a really, really long base, and it's starting to break out of that long consolidation or quiet period. And we're seeing the earnings growth to match that and to reflect that move. So really bullish on the technical side as well. And then from a relative strength perspective, what you're seeing on your chart right here is STNE versus the EWZ, which is the most popular proxy for tracking Brazil. So over this time period, for example, Brazil is down 13.5%. Meanwhile, STNE is up 17.3%. So that's the type of relative strength that I like to see. And then let's move on to the industry group, because the industry group is an important driver. It makes up about 50% of a stock's move. Is what group is the stock in. That will reflect usually how well that stock does. And for STNE, it's ranked in the top 25% of industry groups tracked by Zacks. So all else equal, investors, in my opinion, should focus on the top industry groups and the top stocks within those industry groups, because the top 50% of DAX industry groups tend to outperform the bottom 50% by a factor of 2 to 1. Okay. And lastly, I just want to wrap things up. So in my opinion, let's just reiterate, STNE, it's the Brazilian Square, it's a payments company. It has a lot of the ingredients we look for in big winning stocks, and it's showing large growth potential, dirt cheap valuation, and strong technicals. So I anticipate that this stock will perform in 2024. Okay, and as I said, that wraps up my top stock of the week. I'm going to pass it over to my colleague, Ben Rains, and he's going to take you through his top stock of the week. Thank you, everyone.
Hello, everybody. Ben Rains here. Today, I'm looking at Salesforce, which trades on the ticker CRM. Salesforce has roared higher in 2023 as part of a wave of beaten down growth tech stocks that are rebounding on a new commitment to profits, the eventual end to Fed tightening, and more. And the good thing about Salesforce, too, is it's also still way below its all-time highs, which is positive. So Wall Street's reaction also to the early wave of big tech reports, such as Meta and Microsoft, has been pretty bullish, which could bode well for Salesforce when they report near the end of the month. So CRM has climbed 50% year-to-date in 2023, yet it still hovers just above its pre-pandemic highs from early 2020, and its valuation has improved dramatically, and we'll show some of that in a little bit. So let's dive into more of the company. So Salesforce subscription offerings remain really critical to over 150,000 companies in our digital-driven world. Its various divisions support sales, marketing, e-commerce, customer and client engagement, analytics, app development, and tons more. So the company posted between 25 and 35% sales growth for 10 straight years through fiscal 2022, going from about $3 billion to $26.5 billion in 2022. It's fiscal 2022, which was 2021 for the calendar year. Salesforce's massive and steady expansion highlights the strength of its business model and the constant need for companies of really all shapes and sizes to adapt quickly in the tech-fueled business landscape. So Salesforce has also made some large acquisitions along the way to expand its reach. And then in fiscal 2023, which was last year, its revenue jumped another 18% to boost its adjusted earnings by 10%. And then looking ahead, which is always far more important, obviously, for stocks, CRM projects that its adjusted operating margins will hit 27% in the current year, up from just 22.5%. So this is all part of a new found commitment to improving profitability. So CEO Mark Benioff said last quarter that our goal is to make Salesforce the largest and most profitable software company in the world, and that's what they're doing. So the accelerated transformation plan also includes short-term and long-term restructuring. It's disbanding its M&A committee at the moment, so it's merger and acquisition committee. And so all of these pushes towards greater profitability came amid an activist investor push. So Salesforce is now focused on a transformational FY 2024 that includes a beefed up share repurchase plan from 10 billion to 20 billion. So now we're going to go over and look at some other fundamentals on some of our Zacks.com and CRS platforms. All right, so we can see that Salesforce is currently Zacks ranked #1 strong buy here. And as I mentioned, they're set to report at the end of this month. So let's go ahead and take a look at some of our estimates for what they're going to do on the top and bottom line. So right now, Zacks estimates are calling for another 10% revenue growth this year, all the way up to about 34.6 billion, and then another 11% next year. And then this bottom line growth is what's getting people very excited about. They're going to do about 36% growth this year and then another 23% next year. And we can see that their overall earnings estimates have trended heavily in the right direction recently. So we can see it was at $5.77 per share 90 days ago. It's all the way up to $7.11. Similar situation for next year as well. And then we can see that the company's easily been able to beat over the last 4 periods, which is a solid thing. And then we'll go over here and take a look at this chart. We can see that once the chart pops up, which hopefully it will in a second. If not, there's another way to look at it. It's okay. So that chart's not available this second. So I'll look at this and I'll show you. This is how you can see that their earnings revisions just spiking up higher for this year and next year. And you can see, as I mentioned too, that the stock is still down so much. So now we're going to go over here and take a look at some of the fundamentals, other fundamentals. So we can see Salesforce is trading about 36% below its peaks of the fall of 2021. So now we'll just go do a broader look over the last 5 years, which actually trails its software market. And then if we look over the last 10 years, though, for whatever reason, it's not showing me 10 years. So we'll just go over the last 5 years, and then we'll go over the last 3 years as well. We can see it's still up 23% over the last 3 years, but still lagging that industry. And now we'll go over the last year as well. So the stock is now up 11.5%, so about 12% to finally outpace that industry. And then we can see that that huge jump has essentially happened right off the end of December, and we can see they're up huge, about 50% so far in 2023. So now we can look at some technical charts as well. Here we can look at how the stock's doing compared to its 50-day and 200-day moving average. So we'll break this out to the last 3 years. We can see it hit that golden cross recently, which is where the short-term moving average climbs back above the longer-term moving average. So we can see that it's now well back above both its 50 and 200-day. So it's a positive sign, as a lot of these tech companies experience some bullish technical signals. And then we'll kind of close out with just looking at some valuation metrics. So in terms of their forward PE, this is why this chart's going to look a little goofy, and then we'll show some other things because it was way out of whack for a very long time at Salesforce. So you can see they're now trading at about 37 times forward earnings, about 38 times forward earnings, after trading as high as 200 times forward earnings over the last 5 years. So you can see why companies are finally deciding they need to be focused on profitability as the end of the zero interest rate environment happens. So now we'll look at some forward 12-month sales. And this gives you a sense that it's now, the valuation looks a lot stronger. So it's trading at about 5.6 times forward 12-month sales, which is actually a discount to its computer software market, which is also huge. And then we can show another valuation metric that I think will help investors understand just how strong it's looking. So we can do price to free cash flow, which is also improving as well. So all of its valuation metrics are looking a lot stronger here for Salesforce. So trading about 30.9 times, which is right close to its industry after being way up here. So the things have been completely recalibrated at Salesforce. So overall, its valuation metrics are looking a lot stronger, and it still trades well below those highs. So in the end, Salesforce subscription software offerings aren't going out of style anytime soon. Our digital-driven world and the firm's newfound focus on margins and profitability should attract long-term investors to this tech giant. Salesforce, as I mentioned up top, is currently set to report its first quarter earnings on May 30th. So that does it for me in this episode of Top Stock Picks here at Zacks. Make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more.